Hey everybody. Um, Given the fact that I forgot to hit the record button last night, I thought I would do a quick run through of the problem we did during our synchronous session, and hope this will kind of help remind you of some of the concepts we discussed. I will say that what I'm going through here is really just repeating what some of the other videos, like the fourth video in the week one readings and resources. It also is going through a sample problem much like this, and so you could look at a couple of different examples there. We're going to go through problem 1.5b right now, which is actually one of the practice problems in your templates in Module 1. And so you could perhaps work that first and then watch this to kind of check your understanding. So let me get my picture out of the way and we will go through this. So remember, we start out with various items already existing in the accounting equation. The accounting equation, assets equals liabilities plus owner's equity. So here's the equal sign that we emphasized last night, that this equation will always be equal. So the accounting equation summarizes all of the financial information for a business organization. It's really kind of amazing to think that even a international multi-billion-dollar corporation, all of that financial information is summarized within the context of this fairly simple accounting equation. Assets equals liabilities plus owner's equity. And remember, it's always equal because it's the same money on both sides. On the left, we're going to see a listing of all of the various assets the company owns. And remember, assets are things that we own that give us a future benefit. So on the left is a listing of all the assets, and on the right is where the money came from to get those assets. So it's the same money on both sides. That's why it's always equal. There's three places we can get money. We can borrow the money. We call those liabilities that we have to pay back. And there's various types of liabilities, but it's all borrowed money. And then we also have owner's equity, which has two components. The money that came out of the owner's pocket, we call that paid-in capital, represented by the common stock that they acquired in the business. So that common stock, like in this example, 45,000, indicates that the owners have invested $45,000 out of their own pocket in this business. Of course, the reason they're investing is to see that investment grow, and that we keep up with in retained earnings, which represents the accumulated profits that the company has earned over time, minus any profits that they gave back to the owners, which we call dividends. So what's left are the earnings that we have retained or kept in the business. So as we go through transactions and the company provides services or sells a product to customers, the amounts that we earn from customers are called revenues, and as we're earning those revenues, we're going to incur expenses. And so the difference between those two, revenues minus expenses, that's our net income or profit. And all of those revenues and expenses are going to be listed in the retained earnings column. So we'll see that as we go. So let me just go through some examples and talk about concepts as we go. First, let me summarize what's listed here. As we're starting this particular time period, we have these beginning balances listed in the accounting equation. And so these are the balances that we ended last year with, yesterday. And so now we're starting into a new year. And all of these amounts would have been reported on the balance sheet for the end of the previous period. So we're starting out with cash. We've got accounts receivable of $7,100. That represents what customers owe us because we've already done work for them. So you might think of this as customer accounts that are receivable in the future. They still owe us that money because we've already done the work. We've got some prepaid insurance, representing that we paid some insurance premiums in advance, and now we have the future benefit of that insurance coverage. That's how insurance works. So that's an asset, and we also own some equipment. On the other side of the equation, we've got a couple of liabilities. Accounts payable, those are amounts that we owe to vendors because we were the customer. So they provided something to us, either a product or a service, and we have yet to pay them, so that's a liability. Unearned revenue is the amounts that customers have paid us in advance. So like I mentioned, the example of here later today, we're going to fly back to Memphis. We've already paid for that plane ticket. So right now, the airline, American Airlines, owes us a flight. So to them, that's unearned revenue. Even though we've already paid for it, they haven't earned it yet. Later today, when we take the flight, that liability from them to us will be taken care of, and that will become earned revenue. And so in their accounting, they would lower unearned revenue and move the amount over here as a revenue under retained earnings. And I've already talked about what those two items of owner's equity are. So let's get into the transactions. Transaction A says we collected $6,800 of the amounts due from customers. Well, as I just mentioned, customers owe us $7,100, and now we're getting $6,800 of that, and so we're going to lower what they owe us, subtract from accounts receivable, and add that to cash because they have now paid us. The next one is we provided demolition services. So we're a demolition company, and we provided demolition services to earn $8,300 of the customer advance payments. Well, that was the unearned revenue. The customers had paid us in advance. Now we're doing the work, so that's going to decrease our liability to them, and that $8,300 has now been earned, so we're going to move it over here and add it under retained earnings. And remember, anything you do over here in the retained earnings column, you need to jot down what it is, and that'll make our job in a little bit. When we make the income statement, that'll make that job easier because we'll have a listing there of what those items are. I want you to notice something, that after you've done every transaction, the accounting equation, if you were to stop and add it up, it would always be in balance. In transaction A, we lowered one asset and added to another one. So we only affected the left side of the equation, but it's still in balance. In transaction B, we lowered a liability and added to retained earnings. So again, we only affected one side of the equation, but it's still in balance. In item C, says, by the way, this is problem 15B that you can find in the back of chapter 1 if you want to read along. Item C says we provided additional demolition services totaling $70,000. That's how much work we did. That's going to be the revenue. Anytime you do work, you're going to add revenue under retained earnings. So we're going to be adding $70,000 to the retained earnings, representing the work we did. Now the other question is, have the customers paid for this? Well, they've paid for part of it. $19,000 is still uncollected. So that means that we have collected $51,000. We'll add that to cash, and the $19,000 is added to accounts receivable because they still owe that to us. Now in this one, notice that we changed both sides of the equation. On the right side, retained earnings went up. This is my right. I'm trying to think how this video is coming through to y'all. But the retained earnings is going up by 70,000, and then the assets are also going up by 70,000. And again, I'm trying to relate. I got to watch the video to see if it's reversing this. So anyway, I may be overcomplicating that. Item D, we purchased additional equipment on account. That means we hadn't paid for it yet. We bought it. They added it to our account that we owe. So $8,000. So we're purchasing equipment. Equipment will go up by $8,000, and we're adding that to accounts payable because it's a liability that we now owe for that purchase. Item E, we collected $12,000 in advance from customers. Okay, so we're collecting $12,000. We'll add that to cash. They're paying us for work, but we haven't done it yet. So we still owe them that work. It's an advance payment, so we're going to add that to $12,000 to unearned revenue. Later, when we do the work, is when we'll switch that over to the revenues under retained earnings. So remember, you always record revenue when you do the work, regardless of when the cash is paid. Okay, item F, paid $9,700 of amounts due on account to vendors. So now we're paying off some of that liability, so we will lower cash and we will subtract from the liability the accounts payable owed to our vendors. So now both sides of the equation are coming down by that. Item G, paid wages totaling $50,000 to employees. Okay, so cash, of course, is coming down. And this time we're paying for wages. Wages, we're paying for last week or last whatever the time period is. Wages are paid after the fact. So we're not buying a future benefit. We're paying for something that's already happened. So that's an expense. Remember that assets represent things that we own that give us a future benefit. Expenses, EXP, relate to expired benefits. And so assets relate to the future, expenses relate to the past. Item H, we paid a dividend of $4,500 to the owner. Remember, a dividend is a distribution of profit, and so we are lowering cash, and that is a dividend subtracted from retained earnings. Remember that dividends is a distribution of profit. It doesn't reduce profit, so we're not calling it dividend expense. It simply reduces how much of the profit we're keeping in the business. It decreases the retained earnings. So dividends is not going to appear on the income statement. It'll be taken care of on the statement of retained earnings. Okay, and then we have two more, I and J. And I is we recorded the expired portion of insurance, which is $7,200. So remember, we had some prepaid insurance of $8,800. Now $7,200 of that is expired, which reduces the asset, and the expired portion is now recorded as an expense, insurance expense, which now relates to the past. And in a similar way, we have another asset, equipment, in item J, that is depreciating for $5,900. Fixed assets don't disappear, but they do wear out, and so that wear and tear is reflected by recording depreciation expense. So we're going to lower the asset, and the expired amount is shown as an expense, depreciation expense. So as you record transactions, you want to ask yourself, what was affected? Did it go up or down? And that's what you're recording in the accounting equation. And remember that throughout, the equation will always be equal. So I'm going to highlight that equal sign. It will always be true. Assets will always equal liabilities and owner's equity. Because again, remember, it's the same money on both sides. When you're through recording transactions at the end of the period, we're going to add up the totals, all the columns, and it's a good thing, first of all, just to check and make sure everything's in balance, that your assets do equal the liabilities and owner's equity. And here you can see that they do add up, they are in balance, and so we're in good shape. And now we're going to go to the financial statements. There's 3 financial statements, and these are introduced in Chapter 1. You've got the income statement, and the formula for the income statement is revenue minus expenses. All of your revenues and expenses come over here, are listed under retained earnings. So you want to go through here and pick out all of your revenues. Here we've got 2 of them. And so add those up, and that would go to the top of your income statement. So here's our income statement here. Let me make it a pretty color of some sort. I think I've got all my income statements in pink. So revenues, and then subtract out your expenses, and that's your net income. I've actually already got the financial statements kind of color coded on the next page, so let me go over there real quick. So here's the same information listed, and on the under retained earnings, the items in pink, revenues and expenses, that's what goes to the income statement. Remember, the income statement covers a period of time. In this case, this covers the whole year ended December 31. As I mentioned, the income statement, another name for it is the statement of operations. The income statement is summarizing what you did throughout the entire accounting period, the results of your operations, how much revenue you earned by serving customers, minus the expenses incurred while you're doing that. So there's activity represented on the income statement. So you might think of an income statement as like a video camera capturing all of the revenues and expenses that happen throughout the period. After you calculate the income, we're going to carry the net income to the statement of retained earnings. The statement of retained earnings summarizes how we got from the number at the top of the column, 19.3, to the number at the bottom of the column, 30,000. You can see that up here. We started with 19.3. That was the retained earnings that carried over from the end of last period. And then we had some revenues, expenses, and dividends, so we got down to 30,000. Well, the revenues and expenses are summarized on the income statement. Now we have one more thing to back out, that's the dividends. And so in the statement of retained earnings, we say, okay, that 19.3 we started with, beginning retained earnings, plus the net income that we already calculated on the income statement, minus the dividends. That's how we got to the ending retained earnings of 30,000. And that's the column total that's carried over to the balance sheet. The balance sheet is a summary of the accounting equation. So in our example, all of these column totals in the blue, that's the balance sheet. A listing of your assets, and then where'd the money come from? Well, we've got these liabilities and then owner's equity of $45,000 and ending retained earnings of $30,000. So that's the balance sheet. So as you're going through chapter 1, we're laying the foundation for how we record transactions and then prepare financial statements. As you're recording the transactions, ask yourself, what in the accounting equation, what was affected? Did it go up or down? And so you record that. At the end of the period, that information from that chart is going to be summarized on the financial statements. Nobody, in real life, this chart could be huge because you're going to have, hopefully, lots of business activity, and so lots of lines in the chart. Well, nobody wants to dig through that detail, so we summarize all that in the financial statements. And so here's the general flow. So one more time, income statement, revenues minus expenses is net income. The net income is carried over to the statement of retained earnings, added to the beginning retained earnings, then subtract your dividends, and you've got your ending retained earnings. And that, of course, is the column total that appears on the balance sheet. The bulk of the information is really the operations, the results of operations reported on the income statement, and then the financial position that we're in at the end of the year presented on the balance sheet. The statement of retained earnings is basically a link between those two financial statements. So it does provide some information there, but it's mostly a link between those two. So as I said, the income statement is like a video camera because it covers a period of time. The balance sheet is more like a snapshot because it just says, right now, on December 31, this is the financial position we're in. No movement is shown. This is just the position we're in. That's why the balance sheet is sometimes called the statement of financial position. So that is a couple of questions I could ask about this. What if I said, how much, based on these financial statements here, how much do customers owe us right now? Well, that would be accounts receivable, 19.3. Why do they owe that to us? Well, because we've already done that work. How much do we owe to other vendors for work that they did for us or for maybe product that we purchased? Well, that's accounts payable, 3,700. That's what we owe to others. How about the 13.2, unearned revenue? Who do we owe that to? Well, that represents monies that customers paid in advance. We still owe them a service. That's why it's a liability. So we owe them the service that they've already paid for. If we never get around to doing the work, then we have to give them their money back. So it definitely is a liability. How much work did we do in total for customers in the past year? Well, the amount of work that you did is represented by the revenues that you record. So last year we had total revenues of $78,300. As you compare activity over time, you'd like to see those revenues going up because that indicates that you're doing more and more work for 1 year versus the next. So you'd like to see that business volume increasing. So that's a summary of that's problem 1.5b again, and hope you have fun with it.